Welcome to Paul Fair Associates, a retirement and income solutions firm.
Hello, my name is Paul Fair. My company, Paul Fair Associates, is a registered investment advisory firm providing retirement and income solutions. I have over 23 years experience working with clients to achieve their retirement goals. If you're interested in growth or income, I believe you will enjoy this video. At the end of this presentation, information will be provided to download an overview of the portfolio. I would like to introduce you to a fixed income total return portfolio. The goal of this portfolio is to provide total return, current income, beta management, and risk-reward analysis. The fixed income total return portfolio is one of three income portfolios many of our clients are enjoying today. This portfolio is managed by a $3 billion investment management firm. At the core of this total return portfolio is a strategy of rotating between high-yield bonds, high-quality corporate bonds, treasury bonds, and short-term treasuries. The goal is to invest in the most favorable trend of the fixed income bond sectors by taking advantage of rising markets or safety. This is a snapshot of the portfolio holdings on June 30, 2012. The high-yield bonds generally pay dividends in the 7% plus range. The treasuries and corporate bonds have lower dividends, and the short-term treasury dividends are similar to today's money market rates, but backed by the U.S. government. The present portfolios are about a 50-50 mix of high yield and treasury bonds as noted in the red box. Also, please note this portfolio overall is producing about 4.35% in current dividend. The lower part of this chart shows the various portfolio positions from January 2005 until mid-2012. The dark blue represents high yield bonds, the yellow reflects corporate and/or treasury bond positions, light blue indicates short-term treasuries. During the market decline beginning in 2007 to an uptrend in 2009, there was an important portfolio position as indicated by the red arrow. I'll expand on this later in this video. The objective of this portfolio is to invest in the best performing bond sector. This graph reflects the period of January 2005 until June of 2012. The green line represents the net return of this portfolio. The red line represents the Barclays U.S. Corporate High Yield Bond Index. The deep purple line represents the Barclays U.S. Aggregate Bond Index. The red circle points out the performance of the Barclays High Yield Index in part of 2007 through 2008 timeframes, which reflects a substantial decline in the index. The green circle highlights the net performance of the fixed income total return portfolio in the same time period. While the index was in a steep decline, this portfolio had a stable return due to the total position in short-term treasuries. The lower green circle shows the 2005 to mid-2012 average net performance of the portfolio versus the Barclays Index. Part of this better return was the result of the portfolio avoiding the 2008 substantial drawdown of the index. The largest portfolio drawdown was about 4.47%. As you can see in this bar chart, the high yield index lost 26.16% in 2008, while the portfolio had a net 1.99% gain during the same time. 2009 was a different story. The high yield index was up 58.21%, while the portfolio was up 38.47%. In comparing the index and this managed fixed income portfolio from 2007 until 2009, you can see the portfolio provided positive performance all 3 years, while the index experienced wide swings with substantial losses. Actually, the portfolio began in 2005 with all years producing positive results. Most portfolios use a benchmark to compare performances. The goal of the portfolio is to outperform the benchmark with better returns and less drawdowns. Reducing the volatility is important on a number of different levels. In this chart, the index is in red, the net portfolio is in green. The chart only displays declines, measuring the length, depth, and when the portfolio surpasses the point where the decline began. As we all know, the market goes up and down on a daily basis. I believe this graphic provides a fair comparison of the difference between the benchmark and the low volatility of the fixed income total return portfolio. Although there are many drawdowns, most investors focus on the major events. In this graph, the index produced a 33.31% drawdown lasting about 17 months before returning to the beginning point of the drawdown. The fixed income total return portfolio's largest drawdown was 4.47%, lasting about 10 months, since its inception in 2005. Morningstar is a well-known rating service, which many investors use for information on stocks, bonds, and mutual funds. The rating system ranges from 1 to 5 stars, with 5 stars as the best. However, many people are not aware that Morningstar also rates money managers. This management company has a 4 out of 5 star overall rating for its fixed income portfolios. Additional income portfolios available include a managed corporate bond portfolio, as well as a managed municipal bond portfolio consisting of individual bonds for those who prefer tax-friendly income. As of 2011, the fixed income total return portfolio we have just reviewed is rated by Morningstar to be in the top 1% of their peer group and has outperformed 99% of all U.S. taxable fixed income managers. I hope you found this presentation well worth your time. If you would like additional information on this investment portfolio, other income portfolios, stock market hedging strategy portfolios, or 5 to 8% guaranteed investments, contact me to schedule a confidential review of your financial goals. Don't forget to download the portfolio overview for additional information. I hope you received a benefit and your time was well invested in reviewing this portfolio. If you would like additional information on this investment, other investment portfolios, stock market hedging strategies, or 5 to 8% guaranteed return investments, please contact me to schedule a confidential review of your financial goals. Don't forget to download your review of this presentation. Thanks for attending, and I hope to hear from you soon.